Let's take a closer look at the impact of the debt ceiling, the Fed, and all these things we're talking about on today's market. Joining us here in Santa Barbara is TCW CEO Katie Koch. It's good to have you.
It's great to be here.
Welcome. I think this is the first time we've had you since you've taken over as CEO.
Yes, very exciting.
We talked in Milken. So you're a big bond shop.
Yes.
What do you make of some of the risks out there and the fact that we have seen this bond sell-off and hasn't hit equities as hard this time?
We are in the camp of the medium to hard landing, and when you and I were at Milken, we were on a panel together, and I remarked to you that I thought people were a little bit too happy at that conference, the macroeconomists, the investors. I'm really interested in my time at the CNBC CEO Council Summit that the CEOs are actually decidedly more negative. And I think that's a really, really important data point because as an equity investor, which I did for most of my career, I always found that CEOs were more real-time and closer to real data. And I've met with CEOs everything from donuts to coffee to logistics to people in the asset management space. And people are seeing real degradation, trading down, revenues being muted, and also job losses. So I think that's going to weigh on the economy. And the second thing we can talk about a little bit is that we're having a major call on global liquidity here, which is going to put additional pressure on the economy.
So you don't buy the idea that inflation is still stuck too high, the Fed's going to have to keep going, and the market is too excited about rate cuts?
I do think inflation continues to be an issue, and it is possible that we get another rate hike. In fact, you guys saw markets overnight and this morning pricing in a 50% chance of a 25 basis point hike in June. That's what I mean by the call on global liquidity. That's going to weigh against us. We have regional banks. We have deposit flight from them. And we're hearing from our portfolio companies that they're really struggling to extend loans and tap those revolvers again, which is going to put pressure on markets as well. So we have a real liquidity crunch here, and the combination of the slowing economy and this global call on liquidity leads us to be in this medium to hard landing camp. Now, the good news for us as investors is that we're value-oriented investors, and we really relish leaning into a dislocation for our clients. And so we're focused on those potential dislocations in the broad real estate market and also in private credit.
When you say medium to hard, give us some levels that would get us familiar with what that would feel like, either in economic growth or stocks.
Yeah, so I would say from an economic growth perspective, you could see several percentage points being taken off GDP. And obviously, the important thing to remember from a risk perspective, risk-on perspective, is that, of course, what the Fed's going to do against that backdrop if things get worse is that they will cut rates, and that'll be the path to recovery. But we do expect it's very possible to have a recession at the back end of this year. But now, unlike previously, we do have some of this firepower set up for a recovery.
Would you expect the labor market to start cracking about now?
Yeah,
or is that more of a Q3, Q4 phenomenon?
The labor market, I would argue, already has started to crack, and certainly in the higher-end jobs of technology, for example, we've seen a lot of job loss. Now, those consumers have a lot of pent-up savings, so it takes longer for us to see them come under pressure. But whether it's the credit card companies or some of the consumer companies we were talking about earlier, you're already starting to see the early stages of that coming through. So job market currently under pressure, and I would expect that, to come under more pressure in the back end of the year.
So all this bond bullish?
I think it is possible, if you are selective in what you own, to be bullish on that. We think private credit is going to be an incredible opportunity, but we do think it is very important for manager selection. So if I could just say something very quick on that. Private credit.
Everybody loves private credit right now. But I have to say, at Milken, Katie was the only one that said, hang on, I have a warning for you on private credit, because everyone's in love with it.
Yeah, so I think, good point. We do think it's an epic opportunity over the next 10 years, but we also think it's the first time that manager selection actually might matter. Now, I want to say something quick on a look back and then a look forward. On a look back, this is a very overused term, but it's very apropos to the moment, which is that when the tide goes out, that's when we'll see who's been swimming naked. This is so true of what we are going through in private credit right now, because we have 96% of private credit managers started post-global financial crisis, and we all get to be geniuses when rates are zero to low. Now we've had a massive repricing of that capital. We know that there's been some bad lending because we did not engage in it. We walked away from those deals. Those are deals that were not covenant heavy, as an example, where there wasn't a lot of diligence done. And so there are going to be some accidents ahead. At the same time, on this look forward, if you can be a very conservative manager and do what we've been doing for the last 20 years and that we have not strayed from, and be very covenant heavy, which gives you a seat at the table when things go sideways, and diligence those assets and make good loans, I agree that it could be an incredible opportunity for private credit over the next 10 years. Our team is very, very busy. And that's that. And our team is conservative. So people didn't want our money the last couple of years because we were too demanding. People need our money now. And so that's a good sign for us as a private credit manager and a good sign for the asset class that good deals can be done.